Welcome to episode 5 of Kontrarian Korner. I'm Ben Kelleran. Today we have Steve from Unemployed Value Degen. He's a relatively new Substack, but he's been writing some interesting stuff on a variety of situations. But the one that caught my eye was Transocean. Obviously have similar values as far as what we look for investing. Similar situations we're looking at, but I think it'll be an interesting conversation on some of the stuff he's been writing about, and he's been putting out a lot of interesting content over on a Substack. So, Steve, thanks for coming on.
Thank you for having me. Really happy to be here. I think what I was for 5 years teaching finance to undergraduate students, and I really enjoyed it. And it was an institution where my understanding was pretty much nobody had ever been fired. There was one lady who had a mental breakdown and didn't submit final grades, but other than that, I thought my job was pretty safe. And well, they hired a new president, and I don't want to, I want to remember to be grateful for 5 years of paying the mortgage and health insurance that my wife had 2 kids on and things like that. But it was a bit of a shocker. So I've been making this Substack for 2 weeks, and I got a lot of attention when Tommy Deepwater retweeted my post on Transocean. I think he was very complimentary. He said it was pretty detailed and pretty good, and that was pretty flattering. And one of the things that he followed up with his next weekly report was I had mentioned that Transocean has been saying for 2 quarters now, their management team has been saying that their clients want to engage in longer term contracts, but the longer term contracts take a lot longer to pass through their corporate bureaucracy. So right now we're all just kind of sitting here waiting. Last year was much more fun. You'd get a new press release every month or every couple of months. Hey, here's a new 300-day contract. Here's a new 200-day contract. It was having a positive effect on the stock price, and now it's been pretty much dead silent. But I am a pretty I do have a good bit of confidence in Transocean's management team after listening to a lot of earnings calls. They seem extremely conservative. They seem like they like to under-promise and over-deliver. And they deserve a little bit of leeway after keeping the company out of bankruptcy in the oil bear market from 2014 onward. I mean, that took a lot of prudence. So I do think that Transocean has a pretty good management team. And I typically am relatively distrustful of management, but I think this is probably pretty accurate that within the next, who knows how many months, how many quarters, there should be announcements of some much longer term contracts at some pretty high day rates. And there was even one, I know
pretty high being, sorry to interrupt, but pretty high being 500 to 550, or you think we get a little bit more than that depending, but I'd just be curious to your thoughts on where you're thinking as far as what some of those maybe 3-year contracts, where those price.
Yeah, I mean, it's purely rumors and hearsay, but there was some scuttlebutt about being in the $550,000 to $650,000 range, which would be wonderful. But again, that's takes a lot of time to pass through the bureaucracy. One other thing that's interesting about Transocean is there are 6 ships that are cold stacked, and there's a lot of strong opinions about whether these ships will ever be reactivated again or not, or if they're just scrap metal. But a few quarters ago, Transocean won a Petrobras tender that was going to be a long-term contract to reactivate one of their cold-stacked drill ships. And in the end, even though they were the low bidder, they turned it down because the uncertainty surrounding the reactivation and how long it was going to take and the supply chain crisis and whether they could get all the parts, the penalty for late delivery was so high that they ended up passing on it. And so I don't remember if it was Valaris or Noble that got the contract after them as the second lowest bid. So there's already been some teasers about contracts that are long enough and high enough value. Transocean's promised that they won't put money down to reactivate any of these ships on their own. They're only going to pay for it by having a long-term enough contract. That contract will pay for the reactivation themselves. So
again, I was just gonna say 650 seems like it might be a little bit rich as far as the day rate, but I think you're right on with the reactivations being an interesting thing to watch for. Do you think we get some of those by back half of this year? Or you think it's more going to be a bigger focus for them to try and get some long-term contracts on stuff that's already active.
Yeah, and there's still some white space on their fleet report status, so I don't know what's going to happen this year. I know management team has told us that just logistics of doing it, they could only reactivate at most 2 a year. This is going to be a minimum 3-year process to get their 6 cold stack ships reactivated. So this is a long-term story. I don't anticipate selling any Transocean within 5 years, and this is a very, very long-term thing. But as long as the marginal cost offshore is lower than onshore, then the equipment's going to get used and fetch a good rent. And as far as the life of the ships, some of the ships are about 10 years old, give or take, and typically they have a 30-year life. But after 30 years, if you do a pretty intensive dry dock, which isn't cheap, you can extend it from their 5 years up to 4 times. So this equipment, it could have, some of it could have 40 years left on it. In a world where, I know there's a lot of propaganda about switching over entirely away from gasoline and diesel, before 2035 or something like that. But once you start exploring different areas of the marketplace and listening to more earnings calls, I've heard some of the, most knowledgeable people in the copper mining sector say, no, that's completely impossible. There's not enough copper. There's not enough nickel. There's no way we're going to be off gasoline anytime before 2060. And hopefully they would know if they're responsible for multi-billion-dollar copper mines. So it's I think we're probably going to be on fossil fuels for a good while yet. These ships, some of them have 40 years of usable life left, and I think Transocean's market cap is still something like must be around 5 billion now. It was a little over 4 billion. And this is something that has $20 billion of book value of equipment. And remember, that's their cost. Costs have been going up with inflation. It's probably $40 to $60 billion of replacement costs for this equipment. The shipyards are not eager to build any new ones because they got burned last time when all of their competitors went bankrupt and left the half-built ships abandoned there. So if you were going to build a new one, the shipyards have increased how much you have to put down to build a new drill ship. They want like a 40% down payment on a billion or 1.2 billion or $1.5 billion piece of equipment. I think it's going to be a long time before anybody builds some new ones. So, the supply is not coming anytime soon. Day rates, just cracked $500,000 a day. And I'd have to crunch some more math on this, but even if rates stayed there and Transocean's whole fleet was deployed at that day rate as prices rise, their debt is already pretty sustainable at that point. So for me, the risk here seems pretty small for an upside that it could be, I don't know if the multiples from last cycle will hold, but if you look at last cycle's multiples, that would imply a $25 stock price without any debt repayment. And if the debt's paid down, that would be a $35 stock price from here. So that's a 5 to 7x. And who knows if last cycle's multiples will hold.
Yeah, I think it's interesting to see because, like you said, we're not anywhere near new builds, and even when it starts, it's going to take a lot of time. And there's basically a lot of different factors that are a bottleneck there. As far as the day rates we need to see for new builds, I've heard different things, whether it's 650, 750, kind of depends on what different people are looking at. But where do you think that day rate is where you start to see the incentives line up for certain players in the market to say, hey, we're going to go and build a new build, and it's still 5 years out, but at these day rates, we're going to take some capital and go build a new one?
I think that really depends how bad management is, because you have, a lot of management teams are just willing to incinerate capital and take a chance. I don't think Transocean would order a new ship because their management's more conservative, but who knows about some of the other drillers? They might be, they might be willing to project out what day rates will be 5 years from now and take a chance. That wouldn't surprise me. I think the first step, though, and I had heard this from other people before, is that the cost of operating the business is so high that there's a lot of small drill ship operators that don't make any sense. And we just saw Noble buyout, was it Dolphin?
Diamond.
Diamond. So there's probably a couple more steps in consolidation first, because why order a new rig that's going to be 5 years away when you can just buy the existing ones when they're still selling for below replacement cost anyway. So I think you'll see more consolidation. I don't know if Transocean will participate because they still have their debt burden. And by the end of the consolidation, who knows if they'll still be the market leader. But they're still the technology leader. They still have the two 8th gen ships that do 20,000 psi, which seems to be important in the Gulf of Mexico. I watched your last guest, Smart Order. I like to be a generalist, and as a generalist, I have to learn enough about an industry to make a good decision. And for me, the risk in Transocean, it's mostly de-risked at this point. But you listen to Matt Warder talk about all the different grades of coal and all the different characteristics, and that's a specialist who's super deep into one topic. But the trade-off is, as a generalist, hopefully I can invest in a couple areas and they might become uncorrelated. But if you're entirely in coal or entirely in offshore, good luck trying to find uncorrelated investments. I mean, good luck to me trying to find uncorrelated investments. It seems like everything except AI is down for the last couple of weeks. But that's the hope.
That's the NVIDIA black hole effect over the last couple of weeks. It's always interesting to see. I mean, you have sentiment on oil looking like it's pretty bombed out. You've got like lowest net long positioning, I think, since like 2011 on oil, all these different things. And oh yeah, recession's here, this and that. It's all sky is falling, whatever. Like, we're not going to have a summer driving season, like all these things. I mean, it's just interesting to watch. Like, I think there's a lot of political movement in some of the oil price moves, but that's a separate topic, I guess. On the offshore side of things, do you look at anything outside of deep water, or are you really basically just focused on Transocean and that's your pick in the sector, or do you have any exposure to jackups or OSVs or any other service companies?
I made the decision early to stay away from jackups. I don't know if that's going to be the right decision or the wrong decision, but as a generalist, the setup for ultra deep water and the harsh environment semi-submersibles was just a better structural setup. I mean, the people who buy jackups, they might make a lot of money too, and that's fine. There's plenty of money for all of us. It's just, for me, it didn't seem like a space that I wanted to be in. And I know I had heard pretty early on about Tidewater from Lake Cornelia research. And, it's a good company. The thesis is good, but, and I guess that's why I call myself a value degenerate. Transocean was just so cheap compared to everything else. And I probably will get burned once in a while when I'm choosing between the leader or the laggard in the sector. But what made Transocean really strange is because all their competitors went bankrupt, they're the size leader and the technology leader with the most financial leverage and the most operating leverage, and they're also the cheapest valuation. So Transocean's kind of the leader and the laggard at the same time, which is kind of bizarre. So I usually am just too cheap and too much of a value degenerate to go for the market leader. And so this is a really unique position for me to be in, because when I'm listening to the talking heads on CNBC, every once in a while they'll mention the oil services space. I've heard Transocean mentioned. So when the tourists come in, when the generalists come in and the tourists come in at the top of the cycle, they're going to go to the name that they know. They're going to go to Transocean because they're the biggest in the space. So at some point, it could fetch a higher multiple than their competitors, but now it's still cheaper. So it's a really odd setup.
Yeah, I'm a big bull on jackups, but it's interesting to see like a pretty large chunk of insider selling at Tidewater. I have to do some more digging on that. That's maybe a sign to take some chips off the table if we get a rally here in the next couple months. But anyway, I think it'd be interesting to transition into another area I've started to look at a little bit closer, which is platinum and some of the miners there. I know you've written up Sibanye Stillwater, which is in South Africa, so obviously there's that risk. But from some of the stuff I've seen, it sounds like the election results are pretty favorable, at least for investors from some of the stuff I've seen recently. But it'd be interesting to get your thoughts on Sibanye.
Yeah, so I'm not an expert on South Africa. I've heard from a lot of older, successful investors that you should always look past politics. Now, I'm not so sure. There's that, that old Jack Bogle quote, is that the most dangerous thing is somebody saying this time it's different? Well, years later, he kind of retracted that and said, well, about 20% of the time it really is different. So I know that probably the smartest thing is to always look past politics. But I think in the cases of the BRICS countries with Brazil and South Africa, those countries are so important to China, and China is so heavy-handed with the way that they work with their Silk Road partners, the way they lend for development. I think you're going to see kind of a guidance that if Lula in Brazil wants to do anything too crazy, or if the South African government wants to do anything too crazy, I think the Chinese influence there will keep them a little bit grounded. So I think I'm less worried about political risk in the larger BRICS countries than a lot of people are. But I have heard people say that this election was pretty promising for the future. But I don't know much about that.
Okay. On Sibanye specifically, I kind of look at as like the leverage play on platinum, which I think over time heads higher, but that's obviously remains to be seen. What do you kind of think about the setup there? I mean, it's obviously had a rough couple of years, and like all miners, are generally shitco's, but that's I mean, if you time it right, you can get some massive torque on some of these miners. So Sibanye's been interesting. I haven't bought it yet, but it's definitely at or near the top of the watch list for kind of a small speculation. So what are you looking at there? Where do you think we head over the next, call it 2-3 years?
Well, I went all in on my position size for that segment, and then it keeps just getting cheaper and cheaper and cheaper. So it's a little frustrating for everyone. In my Substack post, I started it with a little catharsis, a little love-hate poem about it from ChatGPT. But there's this old quote from Mark Twain that a mine is a hole in the ground with a liar at the top. And I remember reading that and thinking, oh, wow, the 1860s are so funny. It was the Wild West back then. Then I start listening to mining earnings calls and seeing how they are actually operating their businesses. And I think, oh my God, nothing has changed. They're still shitcos. Now that being said, I was pretty hard on the CEO of Sibanye Stillwater, Neil Froneman, in my Substack because these corporate managers, they just keep on spewing the same ESG talking points, and I just wish some of them would come out and say, hey, our job is to mine platinum and we'll be the best platinum miner, instead of saying, oh, we're going to end racism and we're going to end pollution, we're going to build windmills, all that sort of stuff. But he has outperformed all of his peers since he's been the CEO there. His performance has been really great. So I don't like what he talks about on earnings calls, but his performance has been very good. I started looking at the platinum metals just because they were cheap, but I was also, my primary thesis is we're going to have sustained inflation. And if you're going to have sustained inflation, the three things that outperform in sustained inflation are gold, oil, and land. And I had my gold miner picked out. Sibanye Stillwater they still have these legacy gold mines in South Africa. So it's an industrial metal that still has a large gold exposure. So I kind of wanted that stealth gold exposure. So I like Sibanye Stillwater better than their peers. So they outperform their peers. They have this stealth gold exposure. And then on top of that, they're building out Europe's largest lithium mine. So it seemed like, to me, I liked that strategy. The CEO was saying, I don't know if the battery hybrids are going to win out or if internal combustion is going to win out. I don't know that. I'm a mine operator. But if the electric vehicles win out, we have your lithium. And if internal combustion wins out, we have your platinum. I thought that was a pretty nice internally hedged strategy. And I liked their outperformance over time. And I liked how cheap it was. And I liked the gold exposure because not only do you have gold outperforming in periods of sustained inflation, I think there is a real risk that when the BRICS, after the sanctions were put on Russia and the entire global South said that they are looking for alternatives for the US dollar, it's not like they want to jump in on the Chinese yuan. It's not like they want to use that as a reserve currency, because they know China is for China. They don't have any illusions about that. So in a world where there's no trust, gold is the best money. That's what Ludwig von Mises' book, Theory of Money and Credit, is not a very good translation of the title. The real title was A Theory of Fiduciary Media, a theory of trust money. And it's really about this world where if you have trust, you have no trust. And in a world with no trust, you'll see some of these countries, you see central banks buying gold because it's the best money when there's no trust. And people don't trust each other. Trust is breaking down. What's been amazing, though, and there's going to be a lot of people who kind of will dunk on the de-dollarization thesis, because the US dollar has been increasing in international transactions, but only because the euro has been totally destroyed. The euro went from a third of international transactions to about 15%, right? The European Union is just on the struggle bus so hard, right? With Germany turning off their nuclear plants, and France having declining GDP per capita for 10 years, and Germany deindustrializing. The euro has lost so much ground in international settlements that the US dollar has increased in percentage, but gold has increased in percentage. So a few years ago, people were talking about the de-dollarization thesis, and it appeared to have not played out immediately. I think it's still ongoing. It just hit the euro first, and nobody was expecting that. I didn't hear anybody predict that the euro was going to lose prevalence in international settlement. So anyway, I really liked the gold exposure. I liked the, I'm not a fan of lithium generally, because, and this ties into uranium too. Lithium and uranium can be extracted by drilling a hole in the ground, pumping in chemicals, and slurping out all the material you want, right? The lithium and uranium can be pumped out of the ground, which means you don't have the same resistance to new supply coming online that you have with a mine, where you have to spend years building it out and removing the overburden and moving earth. So I think uranium and lithium mines can come online much more quickly. It's not a space where I really want to be in, but I liked the management from Sibanye Stillwater, knowing that it was a risk and trying to cover that risk, trying to hedge their platinum exposure with some lithium risk management.
Yeah. One of the things, I think it was Trader Ferg was talking about this, but hybrids, which seems like that might actually be the direction we go in as far as mass transportation in some places, take more PGMs for the catalytic converters. So that's interesting. I think a lot of people are very unaware of kind of the supply and demand gap, at least for platinum in that group. So as far as other ideas we kind of have in common, I've been a shareholder of Peabody. I wasn't early enough to scoop up shares a couple of years ago, but they've basically been sideways for me for a while. I think a lot of things are lining up for a pretty good run here, but I'm certainly biased a little bit. I'd be curious to hear your thoughts on Peabody and maybe the coal space in general.
Yeah, this is another one of those situations where I'm attracted to the laggard and not the leader. And when I was coming up with a mascot, I started looking at raccoons because I love trash. Just as a dig on myself, why I keep going for the laggard and I keep getting burned by it. So I think what's really weighing down on Peabody, they authorized this huge share buyback, but they've been dribbling out really slowly. And their competitors authorized huge share buybacks and then just bought quickly. I don't know when Peabody Energy is going to get that discipline. So Peabody is a blend of thermal coal and metallic coal. I was also in Warrior Met Coal until I was using too much leverage and was looking for something to sell to delever, and it had run up pretty well. So Warrior Met Coal is a pure metallic coal play.
I own that one as well. I'm not selling that anytime soon, I don't think. So
yeah, and it's fantastic, and the amount of steel that it takes to build these ridiculous windmills, it's kind of a if the environmentalists win and keep building windmills everywhere, they're going to need an enormous amount of metallic coal to do that. So I really like the coking coal side of things. Thermal coal is really hated But a bizarre thing happened with the war in Ukraine, that when Russian gas was cut off from Europe and Europe wanted to buy up all the gas, after the West had spent years and years and years telling the third world, the global South, that they should switch to natural gas because it, emits less carbon dioxide, well, then Europe drove the price of natural gas up, and then those third world countries couldn't afford it. So if you're in Pakistan, you're in Bangladesh, you're in places like this, and the West has been telling you to build natural gas power plants, and then suddenly they stab you in the back and you can't get natural gas power plants, well, there's thermal coal. And thermal coal, you don't need a special ship. There's already 4,000 bulk tankers that can deliver it. You can just leave it in a pile next to the building, or you don't need any special storage tanks. And so if you're the president of a country where you're worried about, an angry mob storming the palace and bludgeoning you to death, a thermal coal makes a lot of sense in Pakistan, and it makes a lot of sense in South Africa, and it makes a lot of sense in a lot of countries. So even though Norway and the United States is using less thermal coal, I think a lot of countries are going to use more thermal coal. So Peabody Energy is a blend. It has thermal and metallic. It's lagging hard compared to its peers. And again, they have this huge share buyback, and they're just dribbling it out so slowly. I think what I like best about it, though, is because that buyback is there as a threat to supporting the price, I feel pretty bold selling puts on it to raise income. So I like Peabody Energy because it's cheap, and I'm a value degenerate. I like both thermal and metallic coal, and I definitely like selling puts on Peabody Energy.
Yeah, interesting. Yeah, the way I kind of look at it is if you mean, like you said, it's cheap, and if we get natural gas running up, which I think is a definite possibility into the back half of this year and then into 2025, you kind of have that free call option with their thermal. So it would be nice if they could free up some cash from like the asset retirement stuff and use it to buy back. But I think Elliot's going to be out soon. We'll be getting the buyback soon enough. And it's just a matter of, I think I'll give it a couple of years, but it's a matter of time on that one. Yeah. So there were a couple other companies that I found interesting that are targets of shorts and potentially have some issues under the hood, but I haven't done as much of a deep dive into some of these situations. But I know B. Riley is one of those stocks where there's a lot of people that say it's a fraud and talk about it on social media. It's going to zero. The CEO's going to jail, stuff like that. And I haven't looked into it close enough to have an opinion one way or another, really. But that was one thing I found interesting. I think I was reading somewhere that the short interest it's like over 40% or something, which is at least a red flag. So I'd be curious to hear your thoughts on B. Riley, and then maybe we can get into GameStop and medical properties trust. So
yeah, I was surprised that the short interest for B. Riley was able to come down from 90% to 50% without the stock price running up more. But we had heard this from, I think Warren Buffett said at one of his conferences a couple of years ago, that with options around, the markets are so liquid, he can buy just huge pieces of companies without moving the price. And he's just shocked at how much he's able to buy of a company without moving the price. And I was shocked at the short interest. I mean, to fall from 90% to 50% without having a massive squeeze is kind of amazing. B. Riley, what I really like about them is that they're kind of doing, I think, what I would do in their place. So they're a merchant bank. They're a market maker. They underwrite bond issuance. They underwrite people's IPOs, but they focus on small caps. And small caps are kind of a wasteland. You lay down with dogs, you wake up with fleas. Small caps have so many problems. So they kind of do the dirty work in the capital markets that companies like Morgan Stanley don't want to do. Morgan Stanley might tell you, yeah, if you're not issuing $400 million of the bonds, we don't even want your business. So B. Riley is a small cap focused merchant bank. And what really differentiates them is they're willing to play with house money. So if there's a bond issuance and they have done all the work to investigate the company and they like it, they'll buy some of the bonds. They'll just keep them. They'll put that on the house money account. And I think that's fantastic, because in a world where compliance departments tell all these finance professionals you're not allowed to buy anything, you're not allowed to express any opinions, I think it's fantastic to see some people that are just willing to put it on the line, say, this is my research, this is what I believe in, and I'm going to buy it. And if you look at their track record, some of the stuff they bought have been amazing. Some of it still looks like trash, but a lot of it, if we really hit a bull market, I know the S&P 500 is at new all-time highs, but if we really hit a bull market where every dog has its day, they have a lot of stuff in their garage to have a rummage sale that, if it fetches a good multiple, it's just amazing. So their core business is highly cyclical, and IPOs have been dead since interest rates rose. But it looks like it's starting to thaw out. Even though interest rates haven't come down, people just have gotten accustomed to the new normal, and the stock market's relatively high. So we saw the Reddit IPO. We saw Goldman Sachs in the last earnings call, because the larger companies are doing IPOs. Their capital market segment outperformed. So if small caps start jumping on the bandwagon for issuing bonds and going public and doing all their capital market stuff, I think Riley's core business could start making the kind of money that they're used to making in the past. And then on top of that, all the stuff they bought. I mean, they have a telecommunications segment, and I haven't looked at the numbers recently, but their telecommunications segment, I think, is generating $60 million of EBITDA a year that they just send in dividends back to the company. It doesn't contribute any cost, they just send dividends. They have a collection of apparel brands. So they own 43% of Hurley, and they own 41% of Justice. I asked my students at the university if Justice was still because I don't know much about brands myself. And they said that's like Dolce & Gabbana of elementary school, that Justice is still a solid brand, and kids really like it. They own 41% of that. They just so much stuff they bought. And I haven't heard anybody else talk about this, but they even spent $100 million at the COVID lows and made an oil and gas investment in their private equity arm. They've got something like $1 billion in their private equity arm. I don't even know what they own there. And they also have publicly held companies. They have part of what they're doing with their capital market space is actually acting a little bit like a private equity company and trying to rehabilitate some of these things. So there's a company called Babcock and Wilcox, which does power plant servicing. So if you have a coal power plant in Minnesota and there's a company that comes and has the servicing contract, Babcock and Wilcox has this really stable repeat revenue from utilities, but they lost a lot of money as a general contractor making really bad bids to build a couple of solar plants. So they need to get that off their books. They kind of have to eat the loss on that one. But after that's cleaned up, this is really stable recurring revenue from utilities in a world where suddenly, the electric grid is now an artificial intelligence play. So just the amount of crap they own in the garage is just so much. And a lot of it looks pretty bad, but a lot of it will have its day in the sun. The big thing dragging on the stock price right now is they were engaged in the take private of something called the Franchise Group. A Franchise Group used to be publicly traded. It was a collection of 6 brands. One of them they've already sold, Sylvan Learning Center. And in this world where short sellers are always, saying all this awful stuff, if you compare B. Riley's internal estimate from their investor presentation last December, they put the value of Sylvan Learning Center, their guess was 168 million. Well, they turned around and sold it for 185 million. So if B. Riley is, doing a decent job, being a finance professional, being moderately conservative, and their own internal estimates of the stuff they own is underrepresenting things, is fantastic. They're currently shopping around to sell the Vitamin Shop. So, and there's one of those in every city. They estimated Vitamin Shop as a franchise to be worth about $1.1 billion. We'll probably see sometime this year, somebody will bid for it. I mean, the market's at all-time highs. The capital markets are open. Private equity has $2 trillion to spend. Private credit has $3 trillion to spend. If people are looking to get deals done. So I'll be really curious to see if they sell Vitamin Shop at a price below their estimate or above it. But they just, over the years, they have just bought so much stuff. And they do have some debt associated with it. But for me, I love it. It's just I think they're doing a good job. I think they're doing what I would do in their place. So yeah, I'm kind of a fan.
Interesting. Yeah, it sounds like House of Cards is the wrong term, but it sounds like they have a whole bunch of different assets as kind of a hodgepodge collection of all these things, and a little bit complicated, and all those different things that might keep some people away. But I mean, if, like you said, they're able to sell and realize some of those gains, it'd be an interesting setup. As far as GameStop, that's obviously been in the news over the last couple of weeks, but like I don't have any opinion on like the market manipulation, like options trading, stuff like that. I'm not sure what your thoughts are on that situation, or if it's there's actually value there trade. I'd be curious to hear a little bit on GameStop.
So their GameStop has a decent brand. They've got somewhere in the neighborhood of 5 billion annual revenue. The current management team has been working for a couple of years to try and bring their costs down to get them to cash flow break even. And they're just about there. They're just about break even, so they're kind of in stasis. They do have an existential threat, right? You've got the whole gaming world. If you're into PC gaming, it's all done on Steam, so you don't go and buy a physical game anywhere. And with Xbox and PlayStation, all that stuff, they want to get you to download games. Now, there's still some rural parts of the country where people have slow internet connections and they still want to buy physical discs, but GameStop has a real threat to their business model. So now it's about them trying to reinvent themselves, which is risky. But the chairman and CEO, activist and investor who came into GameStop to try and turn it around is the founder of Chewy. Now, this guy, his name is Ryan Cohen. He became a billionaire selling dog food subscriptions. I think that's pretty impressive. Dog food is a competitive space. There's no moat, and it's also that online digital world. So GameStop right now is really a bet on whether you think the guy who became a billionaire selling dog food subscriptions can take the GameStop platform, and now with some at the money offerings, with all the volatility, about $4 billion in cash. And can he do some mergers and acquisitions with that money and breathe some life back into the GameStop brand? It's not the sort of investment that I would usually get into, because I usually am looking for things with kind of more proof of value there. But I have a tiny limited partnership with 4 clients. One of my clients is a total GameStop regard. What do they call themselves? Regarded. And I'm willing to invest his money along with his thesis if I don't disagree with it. And it's not a bad position. I mean, all the controversy aside, an activist investor with a stable platform that's not hemorrhaging cash and a $4 billion war chest of permanent capital is not a terrible position in a world where the implied volatility is so high. I wrote this up on my Substack piece. I've already been paid out an option premia about 63% of my entry price, and that's since 2022. So that's not too bad. I probably wouldn't have invested in it if it wasn't for one of my investors believing in it so strongly. But it's not a terrible thesis. And activist investing could give uncorrelated returns. Everybody's fighting over, how do I get exposure to alternatives? How do I get exposure to private equity, private credit? Activist investing is an alternative investment, can give uncorrelated returns. And it's just really a bet. Can the guy who became a billionaire selling dog food do something in the gaming industry, which is a $200 billion a year industry, with a brand that has a lot of name recognition? So it's not the worst. It's not the worst gamble out there. I'm much more attracted to things that are much deeper value, right? I like that offshore oil equipment, things like that. But I'm not against it.
It's interesting because a lot of people have called it like the melting ice cube or stuff like that for a long time. So it'll be interesting to see if all this like stock market craze actually turns into something more as far as the business. One of the ones that I think it's Hedgeye. One of the guys at Hedgeye has been all over as far as saying it's a short, it's a zero, is Medical Properties Trust. I have some familiarity with the REITs, but I'm not invested outside of kind of one separate situation. But I'd be curious to hear your thoughts on that if you have looked into some of the double dealing or whatever it gets called there, and if there's a fundamental reason the stock is down significantly over the last several years, if you think it's just undervalued, kind of hear your thoughts on the situation there.
Yeah, I mean, I was shocked. So I went all in and I really maxed out my position closer to $5 a share, and then it fell down to $3 a share at the low. I mean, I was just shocked that the marketplace would think acute care hospitals should sell for 25 cents on tangible book, right? That it would somehow be a bad investment idea to be the landlord of acute care hospitals. Now, I listen to some of the people who are into tech transformations. I haven't heard anyone say that acute care hospitals are going to go obsolete. That if you have a heart attack in 20 years, like an Amazon drone is going to drop you a syringe of nanites and it's going to fix your heart. No, in 20 years, you're going to get in an ambulance and you're going to go to the hospital. I mean, the threat of obsolescence is so low. And if you're talking about a major city, who's building new hospitals? Or where are you going to get a large tract of land in the middle of the city to build a new acute care hospital to compete with them? So if you're the landlord of these things, to me, that seems like a pretty good place. Right now, it's selling for 44 cents on the dollar to tangible book. And at its low, it was 25 cents on the dollar to tangible book. It's just such an example of an inefficient marketplace. Now, the reason why I think the market doesn't like it is because their tenants are terrible. But Medical Property Trust has the worst tenants. And in commercial real estate, if you have bad tenants, if your tenants go bankrupt, if your tenants can't pay, well, you take these triple net leases and you lose a tenant. Well, now the landlord is on the hook for property taxes, for maintenance, for insurance. If you're in commercial real estate with thin margins and your tenant goes out of business, you're in serious trouble. You have to pay colliers a commission. It's usually about 4 months worth of rent for collier's commission to find a new tenant. In the marketplace right now, the standard is you give the new tenant about 4 months of free rent for moving in. And the process of finding a new tenant takes 6 to 12 months, during which you're paying property taxes, insurance, and maintenance on this building. So commercial real estate, when you lose a tenant, it's terrible. But acute care hospitals are not allowed to be shut down for 6 to 12 months. When an acute care hospital operator goes bankrupt, the local municipality and the judge get involved and say the hospital is going to stay open. And in a bankruptcy process, all the rent accrued from the start of bankruptcy is the liability of whoever takes it over. So Medical Properties Trust, when their tenants go bankrupt, they don't lose any rent and they don't have to pay the property taxes. They don't have to pay the insurance. They don't have to pay the maintenance. And they don't have to pay colliers a commission to find a new tenant. The bankruptcy judge is going to find them a new tenant. So right now, their largest tenant, Medical Properties Trust's largest tenant, which was responsible for about 25% of their hospitals, is in bankruptcy court right now. And I think the date, I want to say it's January 12th for the first bids on who's going to take over the operations of their hospitals. But once those hospitals have a more creditworthy operator, well, the cap rates on those properties go down, right? Those properties suddenly become more valuable because you go from having the worst tenant in the world to having a pretty good tenant. Those hospitals are much more valuable and then can be sold and recycle the capital, which is what Medical Properties Trust has been doing for the last 15 years. So I think the market's got Medical Properties Trust wrong. All the short reports that talk about, how the behavior was so bad, the behavior was really bad in the tenants. So this Steward Healthcare, their largest tenant, in a zero interest rate world, this guy was trying to just roll up a massive hospital empire, and he was overextended when interest rates rose. That whole empire collapsed. And you could say that Medical Properties Trust enabled him by allowing him to sale lease back his properties, and that's fair. But I think Medical Properties Trust figured out about 10 or 15 years ago that you don't have to be afraid of your tenants going bankrupt when the judge and the municipality is going to guarantee that you don't have, a year with no tenant and where you're on the hook for all these bills yourself. So, I think Medical Properties Trust is intentionally finding bad tenants. I think that's their business model, but it's working for them. They've compounded tangible book value at 10% for the last 15 years. And that's as a REIT where you have to pay 90% of your income out as dividends. So paying out all your income, they've still compounded book value at double digits. I mean, that's amazing. And now it's 44 cents on the dollar for tangible book. And the long run average, it usually sells for about 80 cents on the dollar. So, I'm in. I've asked everybody I met at the university and the College of Business, tell me what I'm missing. How can this company go bankrupt when they're the landlord of acute care hospitals? And I couldn't find anybody to tell me where the risk was in this business. It doesn't make any sense why people would be down on it.
Interesting. Yeah, there's a lot of stuff there that I've heard on different parts of the REIT sector. I know it's with the interest rates going up, it's been tough sledding for a lot of those businesses. Are there any other situations that you think are very appealing today? Any other stuff you're looking at as far as, hey, I really like this one. I think it's very dislocated from fair value.
Well, I just, if I was going to talk about what has the most imminent catalyst, I wrote an article about Forward Air, a logistics company. And that one, the price action, it looks like somebody's buying a big piece of this thing. It looks like that somebody's coming in to take a big stake. So I think that has the most imminent catalyst. I just wrote a paper on Cracker Barrel. Thing is, what's amazing is on Substack, it seems like if you write about gold or you write about offshore, I get about 4 times as much attention as if I write about something else that's really mispriced and undervalued. So maybe I just have to give the marketplace what they want. I think one of the next articles I'm going to write is I'm still bag holding Vermilion Energy. And I can't for the life of me understand why the stock price keeps going down. They have a literal monopoly on natural gas in Ireland. And Ireland is a rich country, right? Ireland GDP per capita is like 55,000 or something like that. And the local government there, they denied permits to build a new natural gas import terminal. They said, well, we're going to be off fossil fuels anyway. Why should we import natural gas? So Vermilion Energy has a literal monopoly with an ESG government preventing more competition from coming in. Europe has had 2 warm winters in a row. Now, maybe we'll have another warm winter. I don't know. But sometime between now and the 10 years that it takes for Europe to be friendly with Russia again, sometime between now and then, there's going to be a cold winter. And Vermilion Energy already, their international exposure is only 30% of their business, and it's generating 70% of their profits because the profit margins on generating natural gas in Europe are just so huge. Now they had there was a problem with the Ukraine war where the European Union did excess profits tax. This company, it's under $2 billion market cap. Ireland just ripped $500 million away from them in excess profits taxes. It's a pretty big taking, and they did it retroactively. In the U.S., when Congress passes a law, it's supposed to be enacted the next session. I guess Europe doesn't really believe in rule of law. They did a retroactive taking of all that money, and I think people are afraid of it happening again. But the European Union put out a clarification last May that said, look, this is bad for energy markets. It's providing uncertainty for energy providers. So please don't do any more excess profit taxes. So the official stance of the Eurocrat bureaucracy is to not do excess profits taxes again. So unless they change their mind. But it looks like Vermilion Energy has a total monopoly in Ireland for natural gas. There's probably at least 10 years before Europe and Russia are friendly again. The government is preventing LNG import terminals from being built. And they're taking up, I think another thing dragging on the price is that they're taking their profits and they're still growing. So they're doing some natural gas drilling in Germany. They're doing some natural gas drilling in Czechoslovakia. and it's a Canadian company, so they're drilling in the Montney. And I think everybody thinks right now that energy companies should only do share buybacks, which is fair. I even wrote a piece about this where if management has to grow, right, which I understand. I mean, if it was my career and somebody told me I'm not allowed to grow my business, I would kind of be pissed. If management has to grow, they should buy out their competitors. And I just shouldn't do organic growth in a world where everybody thinks fossil fuels are evil. So I think Vermilion could do a better job with capital allocation, just buying up smaller companies instead of doing organic growth. But I don't know. I think I bought it at a price to earnings ratio of 2.5. And since then, the price has only fallen. So that's just me being a value degenerate. But at some point, Europe's going to have a cold winter. And even if it doesn't, they just the debt pay down, the share buybacks, their projects coming online. I know I'm going to do finite eventually. It's just so frustrating to watch something that you bought at a PE of 2.5, then fall in price by another third.
Yeah, it's I think for a lot of investors, like looking at the whole situation in Europe, it kind of probably just goes in the too hard pile is kind of it. I assume the reaction on that whole setup. And obviously if you have the past example of the windfall profits tax, that's not going to be real reassuring on the political landscape. But I guess in wrapping up, I've kind of come up with a closing question. And the closing question is, what book do you think I should add to my reading list? Can be history, can be finance, can be anything else, but would be curious to hear what you have as far as a book to add.
Well, I think one of the things that benefited me the most in my development is I read a book on psychology. It was called Opening Skinner's Box. And one of the chapters is about cognitive dissonance. And completely by accident, the very next book I picked up triggered some cognitive dissonance. So I was able to feel it right after I had read about it. And the cognitive dissonance, I have an uncle, my grandmother's brother was a philosophy professor. And I have an uncle who is the CEO of a hardware company. And so at family reunions, it's like, oh, philosophy, underwater basket weaving. But you also have, Carl Sagan and Cosmos. You hear about what these philosophers are able to figure out when they, the birth of all the sciences, theorizing the unsplittable atom, things like that. Philosophy can't be underwater basket weaving and the origin of all the sciences at the same time. So I was really fortunate to read about cognitive dissonance and then immediately have something that triggered cognitive dissonance. So that was Opening Skinner's Box. But I don't know that was really good for me, because just knowing that when you get those butterflies in your stomach, when you read something that makes you start feeling clammy and sweating, that means that in your head you have beliefs that are incongruous, and you have to, figure out which one doesn't serve you anymore and break it down. That's really valuable. But I don't know what you'll find that'll do that for you. Another book that was really impactful for me, there was this guy named Eric Hoffer, and he was a migrant worker. So his whole career was like picking broccoli and picking corn and things like that. But when he was a young child, doctors at the time didn't know why. He probably had a micro stroke. He lost his vision. And then because he was still young enough to have brain plasticity, his vision came back. But he spent his whole life not knowing if his vision would go away. So he was a migrant worker picking broccoli and corn and things like that. But every lunch break and after work every day, he was in the library reading books. And after a lifetime of being a migrant worker who just read books all day in the library in his time off, he was able to write some things with a really unique perspective. So the big book he wrote was called On the Nature of Mass Movements by Eric Hoffer. And that one's a really good read because it's hard to find a truly unique mind like that.
Interesting. I'll add them to the list. My list keeps growing. I'll have to get around to grinding through a couple of them, but I appreciate the Skinner's Box one, especially, is definitely something like you have to be able to hold different ideas in your head when you're looking at investments and looking at all these things. So it's definitely useful to try and have a way to kind of frame that whole idea in your head. So I'll have to look into both of those. With that, I think we'll be wrapping up for today. So thanks for stopping by, and I'll see you next time.